Hey everyone! Nebius Group, trading under the ticker Nbis on NASDAQ, has delivered one of the most eye-catching stock performances of 2025. At one point this year, the share price had surged more than 3 times its original value, climbing roughly 225%. However, that explosive rally didn't come without turbulence. Since peaking in October, the stock has also pulled back by more than 30%, reminding investors just how volatile high-growth technology names can be. With that kind of movement, a natural question now hangs in the air. Where does Nebius go next as we approach 2026? Let's be clear right from the start. Expecting another 200% annual gain would be unrealistic. Those types of returns are rare and usually unsustainable over long periods. That said, the story surrounding Nebius suggests there may still be meaningful upside ahead. In fact, under the right conditions, a doubling of the stock price in 2026 is not out of the question, especially considering the enormous wave of artificial intelligence spending expected over the next several years. To understand why Nebius has become so interesting, it helps to look at its background. The company was originally part of Yandex, often described as Russia's version of Google. After geopolitical tensions escalated and sanctions reshaped the global business landscape, Yandex made the decision to separate its Russian and international operations. From that split, Nebius emerged as an independent entity, relocating its headquarters to Amsterdam and reinventing itself with a sharp focus on AI infrastructure. Today, Nebius operates squarely in the heart of the artificial intelligence boom. Rather than building consumer apps or flashy AI tools, the company focuses on the backbone of the industry: computing power. Nebius owns and leases data centers packed with high-performance graphics processing units, offering a full-stack AI infrastructure solution. These are not experimental customers either. Major technology giants such as Meta and Microsoft have already signed long-term, multi-year agreements with Nebius, signaling strong confidence in its capabilities. Demand for AI compute resources shows no signs of slowing down. In fact, it's accelerating faster than many companies initially anticipated. Nebius itself is a perfect example of that trend. Earlier projections suggested the company would secure around 1 gigawatt of computing capacity for 2026. That estimate has since been dramatically revised upward to more than 2.5 gigawatts. The reason is simple. Demand has been so strong that Nebius has already sold out all of its available computing capacity for the third quarter. That level of demand translated into staggering growth. In the most recent quarter, Nebius reported revenue of $146 million, representing an increase of more than 350% compared to the same period a year earlier. While that number is impressive on its own, it may ultimately look small compared to what lies ahead. For the full year, management expects total revenue to land between $100 million and $550 million. Even more telling is the company's projected annual recurring revenue. Nebius expects that figure to reach between $900 million and $1.1 billion. Annual recurring revenue provides a glimpse into the future, showing what the business could generate if it stopped growing tomorrow. The fact that this number is so much higher than current revenue highlights just how fast Nebius is scaling. Looking ahead, company leadership believes Nebius could achieve between $7 and $9 billion in annual recurring revenue by the end of 2026. Even the lower end of that range represents several times its current run rate. Growth projections like that tend to excite investors and can support substantial stock appreciation, assuming the market remains willing to pay for growth. That brings us to the biggest challenge: valuation. Nebius is not profitable, and profitability is not expected anytime soon. In the latest quarter, while revenue reached $146 million, the company also reported a net loss of around $120 million. This reflects a deliberate strategy of prioritizing expansion over earnings, a move that often divides investors. Traditional valuation metrics offer little comfort here. The stock trades at an extremely high price-to-sales ratio, close to 60 times revenue. That's expensive by almost any standard, especially for a company still posting significant losses. However, when growth is this rapid, valuation often becomes secondary, at least temporarily, as long as execution remains strong. Ultimately, Nebius's stock performance in 2026 may depend less on its own numbers and more on overall market sentiment. Right now, investors appear cautious about artificial intelligence stocks. Despite massive spending, the market wants proof that AI investments are translating into sustainable profits. Until that confidence returns, stocks like Nebius may continue to experience sharp swings in both directions. If optimism around AI strengthens again, Nebius could easily revisit and surpass previous highs. On the other hand, if risk appetite fades, the stock could face meaningful downside. Because of that uncertainty, some investors may prefer a more established player in the AI ecosystem. Companies like Nvidia, which supply the critical hardware powering firms like Nebius and already generate strong, consistent profits. Nebius represents opportunity, but it also represents risk. And in 2026, the balance between those two forces will decide where the stock ultimately lands. Subscribe to my channel. This is not financial advice.